Good morning to you all. We are happy to welcome you on this first edition of the Live Friday Morning Coffee. Today, Leon Kirsch, Chief Investment Officer, leading portfolio manager of our European value strategy, with a proven track record of more than 20 years, an expert in the field, will provide this market outlook, discussing how our strategy has performed since the start of the COVID-19 crisis. When the COVID-19 crisis broke out, the portfolio management team of ECP took the opportunity to reassess and enhance their investment process by creating a new tool called the Quality Value Framework. This new framework is a quantitative mechanism that filters the most profitable qualitative companies. Furthermore, sustainability has gained on importance, and we also increased the weight of those parameters in our investment process, as we strongly believe this is an integral part of future success. Finally, we are seeing this rotation into value, and we wanted to show you how we stand in today's market and how our framework has the capabilities to provide remarkable investment growth. After Leon's presentations, if we have some time left, we will be happy to answer any question you may have via the chat tool, which you can find underneath. So Leon, the floor is yours.
Thanks a lot, Geraldine, and good morning to all of you. We cannot serve you coffee via Zoom today, but I hope we can give you some insight during the next 20 minutes. Performance of value as an investment style has been subdued since the financial crisis. This has been, as we all know, a global phenomenon, as shown on the two graphs here on the slide. So on the left side, we see Europe. Here's a performance of MSCI Europe Value and MSCI Europe Growth, a total return. So if you invested 100 euros in value at the trough of the market in March 2009, just when it started to rebound, it would be worth around 117 euros today. That looks like a good return. That's a 6.9% compounded annual return. But if you compare it to growth, which is the orange line, it's quite mediocre actually. 100 euros invested into an ETF, MSCI Europe Growth total return, would be worth 254 euros today. So that's 11.5% total annual compounded return. In the US, here we have always longer term data, but here you see S&P 500 value against growth. Well, actually, going back to 1975, if you look, actually value had roughly half the performance of growth, as measured by these indices. The trend of underperformance has accelerated during the pandemic, as we also all know, as investors were looking for quality, what perceived quality, stay-home stocks, mainly technology and defensives. At ECP, we compare the performance and valuation gap between value and growth as a rubber band. The more it stretches, the more we believe it becomes unsustainable. We believe that now exactly this point has been reached. And November has been a first sign on how unsustainable the current gap is. Because at the end of the day, the value of a company is the present value of its future cash flows, of its earning power, cash flows. The stabilization process can be brutal and fast. November has shown that. And timing the rotation is extremely difficult. Have here a look on the valuation in Europe and in the US. In Europe, the left-hand graph, undervaluation of value compared to the market is more than one standard deviation away from average. In the US, the right-hand graph, if you look at the 20% lowest value stocks, they have not ever been as cheap against the 20% most expensive stocks in the US since the 90s. So the rubber band is very stretched. But what is the trigger? And to us, to basically reduce that gap and to bring it back to normal, to us the number one trigger to a return in favor of value is reflation. Reflation is due to better economic conditions. Better economic conditions ultimately lead to higher interest rates. And such an environment is extremely supportive for value and has been in the past. So if you look here at the three graphs, if we start by the graph on the top left, what you are seeing here is the difference between 10-year US bond yields and 2-year US bond yields. So this measures how steep the yield curve is. And what you are seeing here is pretty remarkable. In August last year, the yield curve was on the verge of being inverted or flat, at best flat. So the gap was 0. And now we see that currently and over the last months, the yield curve has progressively been starting to steepen. So currently the difference between the 10-year and the 2-year is around 76 pips. But if you look at other indicators, and this is just to summarize here the situation, we believe that better treatment options for COVID-19 and imminent deployment of a vaccine support, of course, a normalization of the economies. And we may very well go to the most optimistic scenario. It has the green line in the forecast from OECD. This is the OECD forecast on world GDP under different scenarios. In the meantime, central banks and governments support very strongly the economies. I also added one other graph. If I look at, in order to show the situation more specifically in Europe, I think value investing and value investors tend to be attracted also by sometimes more cyclical industries. And here in this graph from Société Générale, we compare the performance of historically of cyclicals versus defensives, and we lay it out against the business sentiment. What is very clear, if the business sentiment becomes better, then cyclicals and ultimately value stocks start to perform much better against growth stocks. So, as we believe that this is the scenario we are going in, we believe the trigger is now there. So how have we been doing in this transition? How has ECP been doing? And so what we are seeing, well, of course, there has been a rotation into value in November. But what we have seen since the trough of the markets, that our strategy has been rebounding strongly since mid-March. Of course, from a low level, but the fund, in terms of net return, is up around 43% since the 18th of March, which is the trough of the pandemic-induced correction. With this performance, we have been ahead of the market overall and the value index since that period. I understand it's a short-term period, but I think it bodes well for our portfolio positioning and for the future. Year to date, we are still behind the market with a negative performance as you see, but we are beating the value index. We are convinced that this is due to the work we have done on our investment process, which I will during the pandemic, which I will explain a little bit more in detail now. So there are three core principles to what we are doing. It's quality, sustainability, and valuation. The valuation part I've been discussing very long already before. We are value investors, that's in our DNA. But the other two principles have been reinforced in our investment process. So the quality, the past has shown to every value investors that quality is also important. It's not only about valuation. We need to make sure that the earning power of a company is really sustainable. We should not only look at cyclical rebounds of earnings driven by the overall economic conditions. It's more than that. It's how sustainable a cash flow can be. And we have developed, as Geraldine mentioned, an in-house model to measure that quality, or to give us a good indication where we should spend our resources and build models and do due diligence on the individual companies. The second part is sustainability. As you know, we are a lineage of UNPRI, but we have now integrated ESG on multiple layers in our process. We engage with the companies. We believe that this is crucial because ultimately a company that does not meet these standards will have a problem with its earning power. And the valuation part, I will not go too much in detail now. What is this quality about? Here we combine 19 data points and we rank actually each company compared to our universe of more than 1,500 companies in terms of to assess the quality of the business, the fundamental quality of the business. The fact that we use so many factors enables us to have a good view on each company, and we are not dependent on one data point, where you may have accounting distortions, for example. So this quality score we build for each company is made up of 4 families of ratios. One being profitability, like for example, we measure the net profit margin, we measure return on equity. Another one is growth. Don't be surprised. Growth here means that margins are improving, that return on equity is improving over time. Payout means how much is the company giving back to shareholders? Is it buying back stock? Is the company heavily indebted? And then safety. Safety also has to do with that. If you have a very leveraged business model, if you have a high cyclicality, that may not be the safest investing. So this gives us an impression on each company, just on this data, how it is positioned. So here you have the example of Husqvarna, the Swedish robotic lawn mower producer. So here we decompose in profitability, growth, payout, and safety, and you see how the company is positioned. And on the red line on the graph, you see how this quality score has evolved over time. And what you see is that over more recent years, the management has managed to improve the quality from a negative Z-score in our statistical world to positive one. So there's an improvement on that graph. And this is really the work of the management. They have done restructurings, exited certain businesses, like for example, white label lawn movers, with fuel engines. In the US, they went out, they repositioned the Gardena brand, which is also owned by Husqvarna. So all these measures led to improving quality. Sustainability. So we are not here in the business of greenwashing. We are in the business of trying to make sure we invest in companies that have sustainable earning power. And I think, and we believe, that it's very important if a company has a reputational risk, for example, ultimately it will affect its business and its cash flows. So it has become an important factor for us. We engage with companies. Later on, I will talk a little bit about Lafarge. For example, our ESG officer, Geraldine, engaged directly with Lafarge on these matters in order to make sure we ask the right questions and get the right answers, of course. We are not Fidelity. We are not having a huge impact now on the management of Lafarge. But at least if every investor takes this approach and engages, it will change the mindset of the company, and which we view as something very positive, also for us as shareholders. The valuation part, we also build a value score on each company now. These are 13 data points. We divide in the fundamental value and more the assessment by Mr. Market of the value of sell-side analysts. But I think what is really important, that the core of our investment process with the 7 steps has remained exactly the same. So we continue to build models on each company. We do our 7 steps due diligence in order to assess the earning power. However, we will only look at the companies that have also decent quality scores. Finally, I want to give you an example of one company. It's Lafarge. So as you know, Lafarge is the largest cement producer in the world, has the 2nd largest capacity. It produces market cements, aggregates, and ready-mix concrete. What we like about this company, it has an extremely strong balance sheet and has, contrary in the comparison to others, have a history of consistent positive free cash flow. During the COVID crisis, we had an opportunity to invest in Lafarge, because during the lockdown, of course, everything came to a standstill. But however, the underlying construction market remains pretty strong and is already rebounding. There are no major project cancellations we are aware of to date. At the same time, there is something unique, we believe, with Lafarge. They have an extremely strong management. The CEO comes from Sika, the Swiss materials producer or chemicals materials producer in the building segment, and he is very cost conscious. Has been taken already this year when the lockdown hit. He released a lot of working capital in the company. He cut costs everywhere. I think the company has been very good at adapting. And you see this in the quality score and the value score. Well, not the value score, not yet in the value, but in the quality score. The quality score has been constantly improving, and you would not imagine this quality score for a cement producer. At the same time, on the right graph, you see in green the fundamental value of the company. So basically, it's more than 1 standard deviation cheaper than the overall or the average company in Europe. It's cheaper than its history because the green graph is higher. And at the same time, what you see in the blue line, it's that it's not a very loved company. Sell-side analysts, in terms of ratings, are not, or upgrades, downgrades, are not very positive on the business as we measure with this blue line. So these are interesting companies for us because they generate free cash flow. And we view this very positive. So to finish off, I took here a quote which Warren Buffett already used in a 2008 New York Times article. It comes from, well, we are not so big in Europe in ice skating, but to some of you, Wayne Gretzky may be a reference. He's one of the most renowned, was one of the most, he's still alive, but no longer active, ice skaters we know. And what he was saying, I skate to where the puck is going to be, not where it has been. And now we have, in terms of value investors, we are exactly, I believe, in that position. You have a situation where if you look at cyclically adjusted PEs or Shiller PEs, the US currently trades at 33 times. If I look ex-US in the developed world, it's roughly half in terms of cyclically adjusted PEs. There's no EPS growth coming first in the most cyclical sectors. The rubber band at the same time is very stretched. So the rotation into value, in our opinion, has legs and has further room to go. And we believe that with the addition of more focus on quality, sustainability, and together with our value DNA, we believe we are quite well positioned now. We are definitely not asleep at the wheel. We are very active in our portfolio in trying to identify and make sure we have the right portfolio for the current environment. That's it.
Thank you very much, Leon. I think it was really clear and concise. Are there any questions? You may write them in the chat if you have. So Leon, what is the current margin of safety in the portfolio?
Well, the margin of safety, as you know, that's the discount from between our assessed median fair value of each individual company. We build a model, we have a fair value, we invest when the margin of safety is more than 40%. And currently we are around 34%. So that reflects basically what I said before on how disliked a lot of these companies are. And we believe at what big discounts they trade to fair value.
Okay, thank you. And can you please give an example of one of your latest activities?
Yeah, I can give two examples. One is a company we have in the portfolio is Group 4S, where actually there's currently a bidding war actually emerging in the UK on that company. We are moving closer to our fair value. It's one of these companies where for the moment we are active and watching closely. Another example is Hapag-Lloyd. It's quite interesting because if you look at world trade and at container, at freight rates, you see that basically globalization is not that, and there's still apparently we understand there's a shortage of containers, and there's a shortage of well, that's why the freight rates are going up. Historically, we have been in A.P. Møller-Mærsk some years back, but what we like about Hapag-Lloyd is that they actually are very disciplined and a more pure play on the freight side. And I think the whole industry has been much more disciplined in terms of avoiding to add capacity too much, and at the same time doing these alliances where you have more concentration So it's actually quite an interesting market, we believe, for the moment. And it's in line with our belief that economic conditions will normalize.
Okay, we have 2 minutes left. There's one other comment. It says that there has been different definitions of value in the market apart from the basic price to book. How is value defined from your point of view?
Well, we define value as the capacity, we base it on earning power. So we are not basing it on liquidation value or book value. There has been a lot of discussions about intangibles, about impact. Is price to book a good measure? We are not so much in that discussion. What we look at when we look at a company, we look at how much cash flow can the business generate. And if it's a very good brand, well, I'm not sure it's very well measured in terms of the intangibles in the books. But what is a measurable one is in the P&L, is in the cash flow statement, is the earning power. So what matters to us is the earning power. I think the debate on intangibles, on book value, is to us maybe not exactly the right debate, because it's a debate more on accounting than on actually what a company is able to generate as cash flows. And that's where we base ourselves on. What's the definition of value investing? In my opinion, the best definition I've seen was it's being price sensitive when you invest in an asset. So looking at the price you pay when you invest. And that's what we are trying and continue to try to do. So you probably will not see a Tesla in our portfolio because we cannot assess the future earning power exactly several years down the road of that company. While it may be a very good business, but we are not able to do it.
Thank you very much. Okay, unfortunately, we would have to leave you. Thank you very much all for coming today. We wish you a very nice day. Should you have any questions, please contact me directly, and we will ensure that we provide you all the information you need.